Ratio analysis. Ratio is classified into liquidity ratio, solvency ratio, profitability ratio, and activity ratio. Liquidity ratio is further classified into current ratio, liquid ratio, absolute liquid ratio. Solvency ratio is further classified into debt equity ratio and proprietary ratio. Profitability ratio is further classified into gross profit ratio, net profit ratio, operating profit ratio, and operating ratio. Activity ratio is also known as turnover ratio. It is further classified into capital turnover ratio, fixed asset turnover ratio, stock turnover ratio, debtors turnover ratio, creditors turnover ratio. Liquidity ratio, repayable within a year, also called short-term solvency ratio. Current ratio equal to current asset divided by current liabilities. Current asset means convertible into cash. Liquid ratio, it's also called quick ratio or acid test ratio. Liquid ratio equal to liquid asset divided by current liabilities. Liquid asset equal to current asset minus stock plus prepaid expenses. Absolute liquid ratio, it is also called super quick ratio. Absolute liquid ratio equal to absolute liquid asset divided by liquid liabilities. Absolute liquid ratio equal to cash plus bank plus short-term investment. Liquid liabilities equal to current liabilities minus bank overdraft. Solvency ratio, that is long-term obligations. Quick ratio equal to cash plus government securities plus receivables divided by total current liabilities. Working capital equal to total current assets minus total current liabilities. Debt equity ratio equal to total long-term debt divided by shareholders' funds. Total long-term debt equal to debentures plus long-term loan from banks plus financial and financial institutions. Shareholders fund equal to equity shareholder capital plus preference share capital plus reserves and surpluses. Proprietary ratio equal to shareholders funds proprietary funds divided by total tangible assets. Tangible assets equal to machinery plus furniture plus bank plus cash plus stock. Profitability ratios. Gross profit ratio equal to gross profit divided by sales into 100. Gross profit equal to sales minus cost of goods sold. Cost of goods sold equal to opening stock plus purchases minus closing stock. Net profit ratio equal to net profit divided by sales into 100. Net profit equal to gross profit minus administrative expenses plus selling and distribution expenses plus financial expenses. Operating profit ratio equal to operating profit divided by sales into 100. Operating profit equal to net profit plus non-operating expenses minus non-operating income. Non-operating expenses equal to interest on loan plus loss on sale of assets. Non-operating income equal to dividend plus interest plus received plus profit on sale of asset. Operating profit equal to gross profit minus operating expenses. Operating expenses equal to administration plus selling and distribution expenses. Operating ratio equal to cost of goods sold plus operating expenses divided by sales into 100. Activity ratios. Capital turnover ratio equal to sales divided by capital employed. Sales equal to cash sales plus credit sales minus sales return. Capital employed equal to share capital plus long-term loan plus reserves. Fixed asset turnover ratio equal to sales divided by fixed assets. Fixed asset equal to fixed assets minus depreciation. Stock turnover ratio equal to cost of goods sold divided by average stock. It is also called inventory turnover ratio. Average stock equal to opening stock plus closing stock divided by 2. Cost of goods sold equal to sales minus gross profit. Debtors turnover ratio equal to credit sales divided by average accounts receivable. Accounts receivable equal to sundry debtors plus bills receivable. Average accounts receivable equal to opening, that is debtors plus bills receivable plus closing, debtors plus bills receivable divided by 2. Creditors turnover ratio equal to credit purchases divided by average accounts payable. Accounts payable equal to sundry creditors plus bills payable. Average accounts payable equal to opening, that is creditors plus bills payable plus closing, creditors plus bills payable divided by 2.